Doesn't it feel like a rigged game? You're grinding out a 40, 50, maybe even a 60-hour week. Your paycheck lands, and before you can even smell it, a fat chunk is already gone. Zapped straight to the IRS. And then you scroll through the headlines. Billionaires, people with more money than some countries, somehow paid little to nothing in federal income tax. Think about it. In 2018, Elon Musk paid zero in federal income taxes. Jeff Bezos, the founder of Amazon, did the exact same thing in 2007 and 2011. They didn't cheat. They didn't stash cash in some secret lair. They just used legal strategies written right into our own tax code. Strategies that are, believe it or not, available to everyone. It seems wildly unfair because it is. While the average American household pays about 14% a year in federal taxes, the 25 wealthiest Americans paid a true tax rate of just 3.4% on their wealth. So today, we are looking at the real playbook of the ultra wealthy. This isn't about the little deductions your tax software finds. We are talking about the financial architecture these people use to legally shield fortunes from the IRS. And if you think this is just for billionaires, think again. So, if you're tired of feeling like you are on the losing side of the tax game, stick around. And if you find this useful, do me a solid and hit that like button. The single biggest difference between how the rich and everyone else handle their money comes down to just one thing: how they see the tax code. Most of us look at the tax code and see a giant, complicated burden designed to take our money. The wealthy see it completely differently. To them, it's a roadmap full of incentives. The government wants people to create jobs, provide housing, invest in new energy, and push innovation. So it literally writes massive tax breaks into the law for anyone who does these things. The tax law isn't a punishment, it's a guidebook for building wealth. A regular W 2 employee gets taxed first and then has to live, spend, and invest with whatever is left. The wealthy flip that script. They invest first in the things the government wants them to and then pay taxes on the small amount that might be left over. This is the whole game. So stop thinking like an earner and start thinking like an owner. The second you make that shift, the rules of the tax game start working for you, not against you. So, how do they actually do it? It really boils down to three core strategies. The first and the most powerful strategy is famously called buy, borrow, die. I know it sounds a little intense, but this three step dance is how generational wealth is built and shielded from taxes. Let's break it down. Step one is buy. The wealthy don't chase a massive salary because high incomes get hit with the highest tax rates. Instead, they use their money to buy appreciating assets, things that grow in value over time. We are talking stock portfolios, commercial real estate, private businesses, you name it. The key is they buy and hold. They aren't nervously day trading. They are collecting assets that get more valuable year after year. Step 2 is borrow. This is where the tax magic happens. Let's say a billionaire has a stock portfolio now worth $1 billion, which they started with maybe $100 million. If they sell off $50 million in stock to pay for their lifestyle, they would get hit with a massive capital gains tax bill. But they are smarter than that. They don't sell. Instead, they walk into a bank and take out a loan against their portfolio. The bank happily gives them millions at a super low interest rate because the loan is backed by $1 billion asset. They might borrow, say, $50 million for living expenses. And here's the secret: the IRS doesn't consider loan proceeds to be income. That $50 million is completely tax free. So they get to live off their wealth without ever selling and creating a taxable event. All while their $1 billion portfolio keeps growing, usually faster than the interest on their loan. The step three is die. Okay, it sounds morbid, but this is the final piece of the tax avoidance puzzle. When the wealthy individual passes, their kids inherit the assets. And thanks to a wild part of the tax code called the step up in basis, the asset's original cost is legally reset or stepped up to whatever it's worth on the date of death. In our example, that $1 billion portfolio had $900 million unrealized gain. But when the kids inherit it, the new cost becomes $1 billion. And they could sell the entire thing the very next day for $1 billion and pay absolutely zero capital gains tax. A lifetime of accumulated tax liability is just gone. And this isn't just for billionaires. Anyone with an appreciating asset like your house or a brokerage account can use a mini version of this. Taking out a home equity line of credit for a renovation instead of selling stocks is the borrow principle in action. You are using your assets value tax free. The second strategy is a brilliant accounting trick, turning profitable assets into losses on paper. And the all star player in this game is real estate. Let's say you buy a rental property for $500,000. It's a great investment. And after you collect rent and pay all the bills, you get a positive cash flow of $10,000 for the year. To most people, that's a $10,000 profit you owe tax on. But the rich see it differently. The IRS allows real estate investors a deduction called depreciation. The idea is that a building wears out over time. For residential properties, the IRS lets you write off the value of the building over 27 and a half years. Let's say the building itself is valued at $412,000. Divide that by 27.5 and you get a depreciation deduction of $15,000 every single year. Now watch what happens. You had a real cash profit of $10,000. But for tax purposes, you subtract your $15,000 depreciation deduction. And all of a sudden, your $10,000 profit has become a $5,000 loss on paper. This paper loss not only erases the tax on your rental income, but it can often be used to reduce your taxable income from other places, like your day job. So you own a property that's making you money and going up in value, but on your tax return, it looks like a loser. It's brilliant, and it gets better. Using strategies like cost segregation studies, investors can identify parts of a building that depreciate faster, things like carpets, appliances, and fixtures. They can accelerate these deductions for huge upfront paper losses. And while the old 100% bonus depreciation from 2017 has been phasing down, new legislation in 2025 restored the 100% bonus depreciation for qualified property acquired after January 19, 2025. This is how real estate moguls worth billions can consistently show negative income and legally pay zero income tax for years on end. The third strategy is the big one, shifting from an employee to a business owner. As a W 2 employee, your ability to deduct expenses is incredibly limited. But once you own a business, an LLC, an S Corp, anything, a whole new world of tax deductions opens up. Think about it this way, an LLC owner gets to pay for business expenses before their income is taxed. An employee buys the same things with their after tax money. A business owner buys a new laptop with pre tax dollars. The employee buys the exact same laptop with whatever's left after the IRS already took its slice. So, who's getting the better deal? By running their life through a business, the wealthy can legally write off a portion of their car, their cell phone bill, their home internet, travel, meals, and even part of their house with the home office deduction. They can use something called the Augusta rule to rent their personal home to their own business for up to 14 days a year, and that income is tax free. Choosing the right business structure like a S corp adds another powerful layer. With a standard LLC, all profits are hit with a heavy 15.3% self-employment tax for Social Security and Medicare. But with an S corp, the owner pays themselves a reasonable salary which gets hit with that tax. Any profit above that salary can be taken as a distribution, which is not subject to self-employment tax. So, for a business making $200,000 in profit, if the owner takes a reasonable salary of, say, $80,000, they only pay the 15.3% tax on that amount. The other $120,000 come as a distribution, saving them over $18,000 in taxes, just like that. It's a clear legal way the tax code rewards you for being an owner. The key is to keep everything legitimate and documented. But for those who play it smart, the savings are huge. So, what's the playbook? First, stop thinking about earning and start thinking about owning. Use the buy, borrow, die strategy to grow wealth and then tap into it tax free by borrowing against your assets. Second, get into assets that create paper losses, like real estate with depreciation. You can be cash flow positive while legally showing a loss to the IRS. And third, structure your finances like a business. This moves you from the high tax employee column to the low tax owner column, opening up hundreds of deductions. The tax code isn't just for billionaires, it's a rule book, and anyone can learn how to play the game. The path to paying less tax is to shift from earning to owning by creating jobs, providing housing, and investing in the things our government wants to encourage. The system is actually designed to reward you for it. This is a big change in financial thinking, and it's not easy, but it is absolutely possible. The first step is learning how it all works. If you want to keep going down this rabbit hole to build wealth and legally slash your taxes, make sure you subscribe to this channel and ring that notification bell. And tell me this, what was the most mind blowing strategy for you? Drop it in the comments below.